America's debt isn't a headline anymore, it's a weather system. And as we enter early January 2026, the gauge is sitting around $38.4 trillion. Not as a forecast, not as a campaign number, but as the total weight already hanging from the country's balance sheet. What matters is not that the number is large. What matters is that the number is now large enough to start changing the behavior of everyone who has to live inside it. Governments, banks, pension funds, and the quiet machinery that decides what safe means. And when you see the world's largest asset manager associated with $2.1 trillion are moving, you're not watching politics. You're watching risk leaving a room before the smoke becomes visible. Watch the pipes, not speeches. This isn't a conspiracy theory. The shift won't look like panic, more like a slow hinge turning. Because the real mechanism is an invisible theft of purchasing power. When a state needs to refinance yesterday's promises with tomorrow's money, the system starts protecting itself by pushing capital toward jurisdictions, maturities, and collateral that can't be diluted as easily. Quietly, systematically, and with a patience that feels almost inhuman. Here's the trick your brain plays on you. It treats record debt like a static monument, as if the number itself is the story. But debt is not a monument. Debt is metabolism. And when a metabolism speeds up, you don't feel it as a headline. You feel it as heat, as friction, as fatigue in places that used to move smoothly. Net interest is the heat. It's the bill for running the engine, and that bill is getting close to $1 trillion a year. Not for schools, not for roads, not for anything you can point to, just for the privilege of keeping old borrowing alive. And this is where the narrative flips in a way most people miss. The reserve currency advantage doesn't to remove constraints. It postpones them. Privilege is not immunity, it's leverage. And leverage always has a price. It just charges you later when you've forgotten you borrowed time. Now, let us talk about the phrase in the title, the idea that BlackRock moved $2.1 trillion out of America. If you picture it like a convoy of money leaving the country, you'll misunderstand the signal. The signal is colder than that. BlackRock doesn't decide where the world goes in a heroic, cinematic way. BlackRock measures where the world already is, then builds products that let the world move faster. It's less a kingmaker and more a seismograph. It doesn't cause the earthquake. It draws the line that tells you the plates are grinding. So when an institution with more than $13 trillion under management keeps talking about fragmentation, resilience, and the need to broaden exposure beyond a single market, you should hear it the way you'd hear a building manager quietly installing extra exits. Not because the fire is guaranteed, because the cost of being wrong is now catastrophic. And the $2.1 trillion detail matters because it reveals something about where the fear really lives. In concentration risk, not just concentration in stocks, not just concentration in treasuries, concentration in the plumbing itself, custody, settlement, clearing, counterparties, the hidden dependency graph underneath the entire system. When the pipes are trusted, nobody talks about pipes. When pipes become a topic, it means someone has started imagining a day when water doesn't come out of the tap. Here's a dual truth that can exist at the same time, and it's the kind of contradiction that tells you we're entering a different chapter. Foreign ownership of U.S. treasuries can still hit records, and the quality of the marginal buyer can still deteriorate. Those sound like they cancel each other out, but they don't, because the question isn't, is money buying America? The question is, who is buying, why are they buying, and what are they buying America for? There is a world of difference between a strategic holder parking reserves because it believes in the architecture, and a financial intermediary holding paper because it needs collateral for trades, hedges, swaps. Because the global system still clears through dollar gravity even when belief is thinning. One buyer is faith, the other buyer is habit, and habit can break very quickly when pain arrives. Look closely and the change is visible in the composition. China reducing its holdings over time, Japan and the UK often showing up near the top, custodial hubs swelling, flows rotating, duration preferences shifting. That's not the world dumping America in one dramatic motion. That's the world quietly renegotiating the price of American promises. Because what happens when debt is this high is not that collapse becomes certain. What happens is that optionality dies. Here's the reversal that makes people uncomfortable. The more a system insists it is stable, the more evidence you should look for that it is being stabilized. Stability is not always strength. Sometimes it's intervention with good lighting. And once you start seeing it, you notice it everywhere. The Federal Reserve shrinks its balance sheet, and liquidity becomes less of a background hum and more of a scarce resource with a price tag. Banks become more careful. Credit standards tighten, risk gets repriced. The system doesn't break, it just stops being generous. Two short sentences because this is where the knife turns. Cheap money is gone. So is forgiveness. And this is what moving out of America really translates to for you in practical terms, without any drama. the world begins to demand a higher return for holding long-duration dollar risk. That return shows up as higher borrowing costs for governments, for companies, for households, sometimes directly, sometimes through second-order effects like tighter lending, weaker valuations, slower hiring, and a market that becomes less tolerant of mistakes. If you own a home, you feel it in rates and refinancing windows that close. If you run a business, you feel it in credit lines that suddenly come with questions. If you're salaried, you feel it in the job market cooling without anyone officially calling it a downturn. If you're retired or trying to retire, you feel it when portfolios swing harder, because the old assumption that bonds quietly stabilize everything starts behaving differently in a world where the risk-free asset is no longer psychologically free. This is why I don't like the cartoon version of the story where empires collapse like a movie scene. Most real damage is administrative. It's paperwork. It's rollover schedules. It's auctions that clear, but clear at worse prices. A system can look intact while it's being hollowed out. Spain didn't feel poor while silver ships arrived. It felt chosen. The Dutch didn't feel fragile while finance innovated. It felt inevitable. Britain didn't feel finished after the war. It felt like it had earned rest. And that's the point. The peak never announces itself as the peak. It announces itself as normal. So the BlackRock signal isn't that America is over, or that you should panic buy some magical asset. The signal is that sophisticated capital is treating the future as more politically fragmented, more inflation-sensitive, and more vulnerable to policy constraints than the stories people tell at dinner parties. And when the largest allocator in the room starts emphasizing resilience, diversification, and infrastructure outside the traditional core, it's not because it hates the core, it's because it can do math. Debt doesn't explode like a bomb. It expands like fog. And fog is dangerous precisely because everything looks close, right up until you can't see the cliff. So if you want the clean thesis to hold in your head going forward, it's this. The world isn't leaving America in one loud stampede. It's pricing America differently, and that repricing travels through the pipes first, through custody decisions, through duration, through where incremental flows go, through what gets called neutral allocation. And once the pipes change, the rooms above them always change too. In the late 1940s, Britain didn't collapse in a single dramatic scene. It faded like ink in the rain, slow enough that people could argue it wasn't happening, fast enough that the world quietly built alternatives. The pound had been more than currency. It was permission, a stamped passport for trade, credit, and prestige. But after 2 world wars, the passport started coming with conditions, controls, rationing, debt, and a government trying to keep a global role with a domestic balance sheet that couldn't carry it. What happened next is the part most people forget. The end didn't begin with riots. It began with adjustments, convertibility suspended, capital controls tightened, devaluations that were explained as necessary. Then eventually, the IMF moment, an empire asking for emergency oxygen like a country with no room left to breathe. And the real shift, the one that mattered, was not the day a policy changed. It was the month the serious money stopped treating London like the default. Corporations expanded elsewhere. Talent drifted. Capital found a different harbor. By the time the public felt the cold, the ships were already gone. That's the historical precedent you should keep in your head. Reserve status doesn't get it taken. It gets outgrown by reality. The world simply begins to behave as if your paper is not the center anymore. Now look at the United States in early January 2026. The number sitting on the Treasury's books is $38.4 trillion. That's not a prophecy, that's a measurement. And it doesn't matter because it's big. It matters because it changes the geometry of choices. Here are the silent signals. Small enough to ignore, sharp enough to cut. 1. The debt machine is leaning harder on the short end. More bills, more rolling, more refinancing rhythm. That's not inherently evil. It asks just what you do when the long end demands a higher price than you were willing to pay. It's a subtle trade. Cheaper today, more fragile tomorrow. 2. Foreign holdings can be high at the same time foreign conviction is low. This is where people get fooled by the scoreboard. Foreigners still own a lot of treasuries doesn't answer the real question. The question is whether they own it as belief or as collateral. If it's collateral, it's a tool, not a marriage. Tools get dropped the second they stop working. 3. Watch the custodians. When the United Kingdom rises in the rankings and China slides, you're not necessarily watching national strategy in a clean, direct way. You're watching the plumbing. Who holds what on behalf of whom? The mask matters because it makes the shift look calmer than it is. 4. Central banks keep adding gold. Not because they think gold is magical, but because gold is outside the permission system. It is the one reserve asset that doesn't require someone else's signature to be real. When enough central banks do that at the same time, It's not fashion. It's risk management with a long memory. 5. The language is changing. You hear more talk about resilience, fragmentation, regionalization, friendshoring, redundant supply chains. Those sound like harmless buzzwords until you realize what they translate to in finance: duplication, inefficiency, and higher costs. The world is choosing security over elegance, and elegance is what made the old global system cheap. Individually, these signals are easy to dismiss. Together, they form a sentence. The system is preparing for a future where dollar dominance still exists, but is less exclusive, more negotiated, and more expensive to maintain. Now step back and look at the global positioning, because this is not America versus everyone. It's everyone building escape hatches at the same time. Europe has been pulling in a growing share of global asset management attention, partly because flows follow regulation, and retirement systems, partly because political risk is being spread like a portfolio, not concentrated like a bet. The Middle East is doing something more interesting. It's building markets on purpose, not just buying Western assets, but trying to become a place where assets are issued, financed, and traded. When hubs like Abu Dhabi and Dubai talk about becoming capital markets, not just petrostates, that's a structural shift. That's the world creating more than one financial skyline. Asia is running its own experiment in parallel. Deeper local bond markets, settlement rails, bilateral trade arrangements, and a quiet insistence that not every transaction needs to touch New York before it becomes legitimate. So when you hear the headline claim that BlackRock moved $2.1 trillion out of America, treat it like a flare, not a fact. The deeper truth is colder. BlackRock doesn't need to move anything in a heroic sense. It builds roads. Clients drive on them. If clients want less single-country exposure, BlackRock manufactures the cheapest, most liquid way to do that. If clients want infrastructure in Europe, private credit in the Gulf, or broad EM baskets that reduce one currency concentration, BlackRock supplies it. The point isn't that BlackRock is making a political statement. The point is that the menu is expanding because demand is shifting, and markets are reacting before the public finishes the argument. You can see it in how treasuries trade, term premium trying to rebuild, a market that starts caring again about political risk, auction dynamics, refinancing calendars, and how much paper needs a home. Bonds can rally and still be anxious. Price can go up and trust can go down. Those are not contradictions. That's what a stressed system looks like when it's still functioning. You can see it in gold holding its ground like a patient witness. You can see it in capital's preference for real cash flows, toll roads, energy grids, ports, data centers, assets that don't require a perfect monetary story to stay valuable. And you can see it in the most important place of all, the way the system tries to pretend it still has endless options, because it doesn't. Here's the trap. In a normal world, a government can tighten its belt, raise revenue, cut spending, and grow its way out over time. In a $38.4 trillion world, those knobs still exist, but they don't turn the way they used to. Raise taxes aggressively, and you risk breaking the growth engine you need for the debt ratio. Cut spending hard, and you collide with demographics, entitlements, and political reality. Inflate your way out, and you punish savers while pretending it's normalization. Hold rates too high, and the interest cost becomes a rival power inside the budget. So the system drifts toward the one solution that doesn't require a vote every week. A slow, managed revaluation of what money is worth. Not hyperinflation movie scenes. Something quieter. A long period where the nominal world keeps moving, but the real world, the world adjusted for purchasing power, moves differently. That is why capital starts diversifying before the public panic. Because smart money doesn't wait for certainty. It waits for asymmetry. And right now, the asymmetry is simple. The upside of pretending nothing changes is small, and the downside of being wrong is existential. This is the pattern that matters. Not collapse, but relocation of confidence. First in portfolios, then in settlement habits, then in institutions, then, only at the end, in headlines. And if you want to know what it means for you, don't start with doomsday. Start with mechanics. When the world prices your currency's future as slightly less clean, your life gets slightly more expensive. Credit tightens in ways you feel months later. Asset prices become more sensitive to rates. Employers become less forgiving. The middle becomes thinner, not because anyone announced it, but because the system's margin for error shrank. That's the setup. Not a prophecy, an alignment. Because the next question isn't whether the dollar disappears. The next question is what the transition extracts from people who only own one story, one market, one currency, one plan. What is happening isn't a movie where the dollar wakes up one morning and discovers it as irrelevant. It's closer to a building that still looks solid from the street, while the maintenance team quietly reroutes the electrical wiring because they don't trust a single breaker anymore. That is the mistake people make with the phrase, BlackRock moved $2.1 trillion out of America. They picture money leaving the country like a stampede. They imagine a judgment, a verdict, but the real story is more technical and more revealing. BlackRock didn't pack up America and ship it overseas. What it actually did, in plain terms, was diversify the back-end infrastructure for a massive slice of its US-listed ETF complex, spreading custody, fund administration, accounting, and transfer agency work across multiple firms instead of leaning on one set of pipes. That's not capital flight. That's operational risk management. And in finance, operational risk is what people care about when they're already thinking about tail events, even if they don't say the words out loud. Because a modern market isn't built on opinions. It's built on settlement, on clearing, on the boring promise that when you sell something, it actually arrives, and when you buy something, it actually shows up. Custody is the vault key. Administration is the ledger. Transfer agency is the registry of who owns what. So when an institution associated with the world's biggest pools of indexed money starts distributing those functions across Citi, JP Morgan, BNY Mellon, and others, the message isn't America is doomed. The message is, don't let a single point of failure sit beneath a multi-trillion-dollar machine. Now place that message next to the bigger background noise, and it becomes sharper. As of January 2nd, 2026, the U.S. total public debt outstanding is about $38.42 trillion. That number isn't a debate topic. It's a weight measurement. And debt at that scale behaves like gravity. It doesn't need to scare you. It just changes how everything moves. The hidden mechanism is simple. When the interest bill gets large enough, policy stops being a steering wheel and becomes a seatbelt. You're not choosing the direction anymore. You're trying not to hit the windshield. Net interest is already brushing the edge of $1 trillion a year. Not to build, not to invent, not to expand, just to keep the promises of the past from defaulting in the present. That doesn't guarantee collapse. But it does guarantee a different kind of world. A world where liquidity is less charitable, where duration is less forgiving, where markets punish fantasy faster than they used to. And that is the environment where decisions like move the vault keys start making sense. Here's the part that matters for your life. The system is transitioning from trust as default to trust with conditions. When trust is default, you can run a massive centralized financial empire with a few critical hubs. The hubs are efficient. They save cost. They speed everything up. When trust has conditions, you build redundancy, even if redundancy is inefficient, because the penalty for a single breakdown becomes intolerable. That's why the story isn't just about BlackRock. It's about everyone reading the same room temperature. Look at foreign holdings of treasuries. The top holders still sit in the same table, but the internal logic is changing. Japan is around $1.2 trillion in holdings, as of the latest data available for late 2025. The UK is hundreds of billions, and China is around $688.7 billion. The headline version of that is, foreigners still own a lot of US debt. The real version is, the global system still uses treasuries as collateral, because there is no cleaner collateral at that scale. But the psychology around long-term US fiscal risk is no longer sleepy. And you can see that psychology in where demand concentrates, in how the long end needs a higher reward, in how auctions get analyzed like weather forecasts, in how every political fight over budgets and shutdowns echoes directly into term premium. None of this requires a grand anti-American conspiracy. It requires only math and self-preservation. Now let's talk about who wins and who loses in a world like that, because this is where people want a simple villain and a simple hero, and they don't get one. The winners are not necessarily the rich. The winners are the people closest to the pipes, institutions that collect fees on flows rather than taking balance sheet risk, firms that own infrastructure with contracted cash flows, entities that can refinance on better terms than you can, businesses with pricing power, households with optionality, meaning low fixed obligations and the ability to move, switch jobs, switch countries, switch currency exposure. In a world where purchasing power is shaved quietly, optionality is a weapon. The losers aren't defined by morality either. They're defined by rigidity. People whose wealth is concentrated in one currency, one housing market, one job sector, one retirement plan, one narrative. People with high fixed payments that depend on low rates staying low. Savers who think safe means cannot move. Workers whose wages are slow while the cost of essentials is fast. Small businesses that rely on easy credit and stable demand. When the system reprices risk, rigidity becomes expensive. Now here's the timeline. Not as prophecy, but as the typical rhythm of systems that are moving from centralization to redundancy. Phase 1 is what 2025 looked like and what early 2026 continues to look like: accumulation under stress. The debt keeps rising, but the system still functions. Markets still clear. People still argue online as if arguments change arithmetic. Institutions quietly rebalance, not all out, but less concentrated. In this phase, the most important changes are invisible. They live in custody arrangements, margin rules, collateral preferences, and flow patterns. You don't feel it as panic. You feel it as a slightly harsher cost of money. Phase 2 is what the next 12 to 24 months can resemble if fiscal and geopolitical noise stays elevated. Stress becomes visible. You see more surprises that aren't actually surprises, because the data already pointed there. You see liquidity events that feel localized but reveal something systemic. You see more volatility around auctions, around policy announcements, around inflation prints, around geopolitical flare-ups, around banking sector headlines. In this phase, narratives become weapons. Every side sells you a story. The market doesn't buy the stories equally. It buys the cash flows and the collateral. Phase 3 is the slow re-rating that can extend over years. Structural repricing. This isn't a reset button. It's a gradual change in what the world demands from U.S. assets to keep holding them in size. Higher compensation for duration. More premium for political stability. A subtle premium for redundancy. More weight toward real assets and contracted cash flows. More regional capital markets growing up, not to replace the U.S., but to reduce dependence on it. This is where the world doesn't abandon the dollar so much as it stops treating the dollar as the only hallway in the building. And that takes us back to BlackRock. If you want the clean interpretation, it's this. The most sophisticated institutions don't wait for the headline. They build the exits before the smoke gets thick enough to argue about. They don't move because they're certain. They move because the cost of being late is asymmetric. So what should you do with that in real life without turning into a doomsday hobbyist? First, stop interpreting financial headlines as moral statements. They're usually engineering decisions. Second, measure your own concentration risk the way an institution would. Not emotionally, mechanically. One currency, one job sector, one geography, one type of asset, one counterparty, one plan. Third, treat liquidity like oxygen. You don't need to hoard it forever, but you do need to know where it is, how fast you can access it, and what assumptions your life makes about credit staying friendly. Fourth, build optionality where you can. Skills that travel, networks that are real, a balance sheet that isn't fragile, and a portfolio that doesn't rely on one story remaining dominant forever. That's not fear. That's adulthood. If you want, I'll keep mapping the signals that actually matter, the ones in the pipes, not the ones in the speeches, so you can see shifts early, while they still look boring.